Good morning, everyone, and thank you for joining us today for the launch of our annual Water Markets Report. My name is Ben Williams, and I'm an Associate Director in the Water Economics Policy and Strategy team here at WSP. I'm joined today by the familiar faces of Steph Finnegan and Rajiv Venkatraman. But before we get started, I'd like to acknowledge that I'm joining you from Kaurna country today in Adelaide. And I'd like to acknowledge the Kaurna people as the traditional custodians of this unceded land. First Nations people of this country hold a wealth of knowledge about caring for country, including its water, which has been handed down across generations for more than 60,000 years. I'd like to pay my respects to elders past and present and extend that respect to any First Nations people who are joining us here today. Well, this is our 13th edition of our annual Water Markets Report and the first in our new WSP livery. It has been our contribution to water market transparency that had its genesis back at AETHA back in 2012. And as always, the Water Markets Report is a team effort, and I'd like to thank my team for all of their hard work in compiling this year's report. Steph, Rajiv, Ellis, and Duncan have done a great job with this year's report, and I'd like to thank all for their involvement. Well, we say this every year, but it is definitely true. 2025-26 was a really interesting year in water markets, from Commonwealth buybacks through to the impact of the Israel-US war with Iran. Today, we'll begin with a look at our analysis and findings from the year that was, and then we'll discuss water recovery and the Basin Plan review. We'll finish with a look at what the year ahead might hold. In all, we're aiming for around about 45 minutes, and there will be some time at the end for questions. We've already received a few since the report was released, and if there's anything that you'd like to ask today, please put it in the Q&A, and we'll try to get to as many as we can at the end. So with that in mind, let's begin with a brief recap on the year that has passed, and over to you, Rajiv.
Thanks, Ben. In summary, there are three key insights summarizing the 2025-26 water year in the Southern Murray-Darling Basin, or MDB for short. Here is a snapshot. Starting with allocation markets, the total volume allocated to major Southern MDB entitlements in 2025-26 was the lowest in 6 years. This was mainly driven by reduced allocations to general security entitlements. Even when we include carryover on general security and low reliability, overall water availability was still down 32% from 2024-25. 2025-26 also saw water availability dip below the long-term 20-year average for the first time since 2019-20. Next, water held in Southern MDB storages fell by 10% between the start and the end of the water year. A combination of reasonable water availability at the start of the year, large annual cropping programs, and low inflows to storages meant that 2025-26 saw the third largest drawdown in the last decade. This brought end-of-year volumes to their lowest level since 2019-20. Lastly, entitlement markets increased for the second year in a row, albeit at their smallest annual level by 2.8%. This reflects continued upward price pressure from government buybacks and increased interest in highly reliable entitlements over concerns of a dry 2026-27. Now let's unpack some of these topics in more detail. First, let's dive into Southern MDB storages. As mentioned, we saw the third largest annual drawdown in major Southern MDB storages in the last decade. This reduced the total volume of water held, including consumptive and environmental water, to around 6,500 gigalitres, down from 7,800 gigalitres at the same time last year. Let's take a closer look at what happened. On this chart, I'm going to show the total volume held in the 6 major storages in the Southern Connected System: Hume, Dartmouth, Blowering, Burrinjuck, Eildon, and Menindee Lakes. The timeline begins in 2000 when our data commences to the end of 2025-26. Here we see how storages in 2025-26 initially increased as expected over the winter months before peaking in September. This then began dropping in the lead up to and during the summer irrigation period. A key driver was reasonably high water availability at the start of the year, driving annual croppers to plan for relatively high planting areas. This was then followed by below average inflows, which increased reliance on water deliveries from storages before, during, and after the summer irrigation period. The nature of storages in 2025-26 carries interesting parallels to another year, namely 2018-19, as per this chart here. This is another year where storages followed a similar pattern, with the starting and end volumes at similar points to 2025-26. A key difference was that the Menindee Lakes played a much bigger role in 2025-26 in providing water. This helped preserve water in upstream storages. Next, let's take a look at allocation markets. In 2025-26, we saw allocation prices increase again between the start and end of the year. This is the second consecutive annual increase, with a near doubling of prices once again. So how did this increase pan out over the course of the 12 months? This chart shows weekly volume-weighted average prices averaged across the Southern MDB. What we see is that starting in July, prices were relatively steady and actually trended downward. This was in response to both buyers and sellers holding off on any transactions as they awaited how winter rainfall would materialize against an above-average outlook. This changed in September as below-average rainfall persisted across the Southern Basin, and buyers began securing their water supplies in the lead up to the summer irrigation period. This upward price trend continued and peaked at around $400 in March 2026. This was then followed by a steady downward price trend. What makes this interesting is that the Bureau was forecasting a dry autumn and winter, which could mean below average rainfall in 2026-27. Now, you would think people would want to secure water for carryover, which would drive prices higher. However, instead, prices dropped. This was potentially driven by the Middle East conflict beginning around March, which pushed up input costs such as fuel and fertilizer. This likely drove irrigators to sell their allocation water holdings to shore up their business operations. However, prices did start increasing towards 30 June as carryover demand began to increase. Next, let's examine entitlement markets. As I said at the beginning, entitlement markets saw a second consecutive year of price rises as government buybacks continued and irrigators sought highly reliable entitlements for a potentially dry 2026-27. WSP's way of examining the overall state of entitlement prices is via our WSP Water Entitlement Index, also known as the WEI. This index tracks the relative performance of a group of major water entitlements across the Southern MDB. I should note the WEI tends to ignore government buybacks, as data released to date on buybacks does not show when the transaction was actually agreed upon, while the WEI prioritizes data that accurately reflects current prices. The WEI finished overall 2.8% up between the start and end of 2025-26. This was the smallest annual increase since the index began in 2008. Let's take a closer look. Regular followers of our webinars are familiar that after a period of declining prices till 2013-14, there was a period of growth that peaked in 22-23. This was followed by almost 2 years of softening prices from 2022-23, driven by economic challenges and increasing interest rates. This was particularly felt among wine grape growers, many of whom sold entitlements for cash flow, which increased supply and put downward price pressure. But starting from 2024-25, prices began following an upward trend continuing into 2025-26. So how exactly did this play out? The WEI fell in the first few months of the year. This was driven by forecast dry conditions, reducing interest in general security and low reliability entitlements. Such entitlements typically receive low or no allocations in such conditions. The second half of the year saw a different story, with the WEI increasing steadily, and this was driven by two key factors. A, many participants who sold water to the Commonwealth were re-entering the market to repurchase new entitlements, particularly high security and high reliability entitlements. B, some irrigators were also looking to purchase high security and high reliability entitlements over concerns of a potentially dry 2026-27. While the WEI generally excludes buyback trades, such trades do lift expectations among buyers and sellers, creating a base of upward price pressure across the year. This is driven by sellers choosing to exclusively offer their parcels to the government at a premium instead of the broader market. Now, with the WEI generally excluding buyback trades, viewers of this webinar are likely wondering, how have buybacks influenced the entitlement market? First, let's take a look at commercial trade volume activity. This chart shows historic trade activity for major Southern MDB entitlements and excludes $0 trades. Commercial activity in 2025-26 has almost doubled from 116 gigaliters in 2024-25 to 215 gigaliters. This is an 85% increase and is the highest volume in almost a decade since the previous peak in 2015-16. Now, a key question is how much of this increase has been driven by Commonwealth activity? WSP have developed an in-house method using publicly released information, and based on this method, we have identified 126 gigaliters of recorded trades likely related to buybacks and related to the 450 gigaliter target. This represents 59% of trades. I should note we are excluding the bridging the gap target here. This means non-Commonwealth activity is 89 gigaliters, a number more in line with volumes from previous years. However, it should be noted that this data is based on the recorded date of the trade on state water registers, which is typically much later than when the trade was actually agreed upon. Now, the second question in the mind of viewers is, how has the overall value of the entitlement market been affected? Well, this chart examines that by overlaying the volume of the trade with its associated price. And here we see that of $1 billion in entitlement trade in the Southern Basin, almost 50% of it, 590 million, is related to buybacks. This shows the extent to which the Commonwealth has created a floor of demand in the market. Without this, the entitlement prices would likely either remain steady or fall. While we expected Commonwealth buybacks to represent a higher proportion of this $1 billion, the Commonwealth's purchases also include cheaper general security and low reliability entitlements. I will now pass on to Stephanie, who will present a policy and management update for 2025-26. Over to you, Steph.
Thanks, Rajiv. The 2025-26 year has been characterised by two major policy developments. The first is the commencement of the Basin Plan's legislated 10-year review, which is likely to influence how water is managed across the basin over the next decade. The second is the continued acceleration of water recovery under the Basin Plan, particularly efforts to achieve the additional 450 gigalitres of additional environmental water by the end of 2027. The key headline from the year is that recovery has continued to progress at a significant pace. By the end of the 2025-26 water year, the Commonwealth had recovered approximately 278 gigalitres towards the additional 450 gigalitre target. The Q's latest implementation update has indicated recovery could reach around 400 gigalitres by the end of 2026. On the surface, this suggests the Commonwealth is making strong progress towards meeting the legislated 2027 deadline. However, the more important issue for markets is what happens next. The major uncertainty is now the Sustainable Diversion Limit Adjustment Mechanism, or SIDLAM for short. The latest MDBA report indicates that some major supply projects are behind schedule and may not be delivered before the December 2026 deadline. In June 2026, Basin governments notified the withdrawal of 14 SIDLAM supply measures that will not be delivered in time, significantly increasing the likelihood of a material shortfall against the 605 gigalitre SIDLAM target. Depending on the final reconciliation outcome, which is due at the end of 2026, the Basin could face a shortfall of between 255 and 355 gigalitres. The higher end of that range is currently being considered more likely. As a result, market participants remain focused not just on the remaining 450 gigalitre target, but also on whether the additional recovery may be required to offset any SIDLAM shortfall. Analysis of recovery to date shows several clear market signals emerge. First, New South Wales has been the dominant recovery area, accounting for approximately 57% of recovered volumes. Victoria has contributed most of the remaining recovery volume, while South Australia has seen limited activity. Second, recovery has been heavily concentrated in the major southern connected systems, particularly the Murray, Murrumbidgee and Goulburn markets. These markets offer larger entitlement pools, the greatest liquidity and the highest levels of seller participation. Third, recovery activity has been largely absent from smaller markets despite being included in recent tenders. From a market perspective, the Commonwealth has clearly prioritised efficiency by targeting markets where large volumes can be acquired with relatively limited transaction costs and market disruption. This has been particularly evident through EOI2, which sought portfolios of water 20 gigalitres and above, and has contributed significantly to the speed at which water has been recovered. An example of this is a singular sale in March 2025, wherein Duxton Water sold almost 31 gigs of water, including 14.5 gigalitres in the Goulburn, which has contributed significantly to its recovery numbers in this zone. When we looked beyond the volumes recovered, several broader themes become apparent. Approximately 60% of recovered water has come from lower reliability entitlement products. This reflects a strategy aimed at maximising recovery volumes while minimising acquisition costs. As a result, recovery activity has been concentrated in entitlement classes that offer the largest nominal volumes for each dollar spent. WSP's analysis also indicates that Commonwealth purchases have often occurred above the prevailing market prices. In several entitlement classes, with the highest acquisition premiums seen to range from 25% to 70% above the average 2024 to 25 VWAP. This suggests that premiums are increasingly required to attract willing sellers. However, this comes with a caveat. Because there is a lag between offers being made and accepted into Commonwealth tenders, the trades appearing in the water registers, changes in market prices can materially affect the apparent premium. While the analysis suggests premiums of up to 70% in 1A Goulburn Low, these figures are not necessarily a like-for-like comparison. The fair market value of 1A Low entitlements fell by 21% between June 25 and June 26. Using the 2025-26 VWAP as a benchmark, the Commonwealth's purchase represent a 70% premium relative to the prevailing market prices. This is because of the fall in entitlement markets due to factors such as dry conditions, a low risk of spill, and weaker market demand. The key implication is that further recovery remains achievable, particularly within the Southern Basin markets, but the cost of recovery is likely to increase as the remaining pool of willing sellers becomes smaller. From what we have observed, 20 to 30% seems to be the prevailing premium the Commonwealth has been willing to pay under the program so far. While recovery is focused on completing the current Basin Plan, the Basin Plan review is focused on what comes next. The Basin Plan review is a legislative review that occurs every 10 years to assess whether the plan remains fit for purpose and whether it can continue to achieve its environmental, economic and social objectives. The MDBA is due to provide recommendations to Basin governments by the end of 2026. Importantly, this review is occurring at a time when governments are simultaneously trying to complete existing Basin Plan recovery commitments while also planning for a future that is expected to be hotter, more variable and increasingly influenced by climate change. As a result, the review is not simply looking backwards at what has been achieved over the last decade, but is exploring questions around environmental outcomes, water market performance, environmental water management, water recovery programs, climate resilience, and socioeconomic impacts over the next decade. Additionally, national water reform is advancing on several fronts. Governments are developing a new national water agreement to replace the 2004 National Water Initiative and guide water policy across Australia for decades to come. While a statutory review of the Inspector General of Water Compliance is assessing whether basin compliance, enforcement and accountability arrangements remain fit for purpose. At the same time, the Australian Government is undertaking the second statutory review of the Water Act to determine whether the legislative framework underpinning the Basin Plan remains effective in addressing evolving environmental, economic, and community priorities, including climate change and water market performance. When viewed together, these represent the most significant water policy reform agenda since the Basin Plan was originally established. Collectively, these processes are examining not only how the current framework has performed, but how Australia's water governance arrangements should evolve to respond to climate change, future water security challenges, and community expectations over the coming decade. Ultimately, the key issue for markets is not whether these reviews will produce change, but what type of change they recommend. The outcome will help determine future water availability, recovery options, environmental water management priorities, and invest confidence across water markets well beyond 2027. And with that, I'll hand it back to Ben for the 2026-27 water market outlook.
Thanks, Steph. Now let's have a look at the year ahead. We've had a relatively wet start to the year in July, and for many, the last week or so has been very wet. Certainly has been here in Adelaide. And there's been some meaningful improvements in water storages, but the outlook to mid-spring suggests there's a different story lying ahead. The September to November period, the Bureau's outlook suggests that there's around a 1 in 4 chance of receiving above median rainfall across the basin. At the same time, the probability of unusually dry conditions is relatively elevated, and particularly in southern catchments. The graphic looks at the probabilistic forecasts in the growing regions, and for this slide, I've used Mildura, Griffith, Deniliquin, Shepparton, and Moree here. The Lower Murray has a 1 in 4 chance of above median rainfall, with the likelihood of unusually dry conditions sitting around 34%. Further upstream, however, conditions become progressively drier, with the Upper Murray, Goulburn, and the Murrumbidgee showing a greater risk of below average rainfall, and a near 50% chance of unusually dry conditions in the Murrumbidgee. The key message here is that currently there's little indication of a widespread wet pattern emerging through spring, and whilst rainfall events are still going to occur, the outlook is still favouring relatively dry conditions across much of the southern basin. Conditions in the northern basin are nearing a 50-50 chance of exceeding median rainfall, which is an improvement on the last couple of months. From a water market perspective, this outlook suggests that demand for allocation could remain high and might increase market sensitivity to any deterioration in inflows, storage outlooks, or allocation expectations over the coming months. But of course, it's not the full story. Whilst the previous slide looked at conditions across the irrigation regions, on this slide, I'm going to focus on the key storage catchments that drive water supply outcomes. And the signal here is notably drier. Across the Murray, Murrumbidgee, Goulburn, and Lachlan headwater catchments, the probability of median rainfall has improved, but it remains low, ranging from just 20 to 24%. At the same time, the likelihood of unusually dry conditions continues to be elevated, and particularly in the Goulburn systems where probabilities exceed 60%. So while irrigation regions might have better chances of receiving local rainfall, conditions over the headwater catchments are much more important for replenishing system water supplies and improving the allocation outlook. The outlook in the Northern Basin is much more positive. Taking the Guida for an example, the chance of exceeding median rainfall here is now almost 50%. Whilst the chances of unusually dry conditions has fallen to around 27%. This has changed markedly in the last 2 weeks. Whilst the storage levels remain relatively healthy, a continuation of dry conditions would likely reinforce market focus on inflows, allocation determinations, and carryover availability as we move into the irrigation season. Looking ahead, water markets are likely to remain under pressure for the coming year. Since July 2023, there's only been 4 months where inflows have been above the long-term average. 31 months below the long-term average since July 2023, and July this year is the first time since December 2022 that the daily inflows have approached 100 gigalitres per day in the Murray. With forecasts pointing to potentially drier conditions still, particularly across the key catchments, there's a real possibility that supply remains constrained over the coming years. Those storage conditions flow directly into allocation markets, and as a result, allocation prices are expected to remain above the long-term averages. Recent rainfall has been driving allocation markets through the start of this year, with prices having softened in the past week or so to 380 in the Lower Murray. But the onset of dry conditions would bring the market back into sharp focus. Demand in the Lower Murray is likely to remain high, meaning we're also likely to see a more segmented market due to trade restrictions. It's against that backdrop that some market participants are already looking towards the 27-28 water year with a degree of nervousness. In entitlement markets, the Commonwealth is likely to remain a key focus for the year ahead, maintaining a floor in entitlement values. And as Steph mentioned, there'll be significant interest in the outcome of the SIDLAM reconciliation at the end of this year, and more importantly, what the plan for recovery is of any likely shortfall. More broadly, the combination of economic uncertainty, geopolitical instability, changes to tax policy, and the lagged impact of recent interest rate rises seems to be having a cooling effect on demand for entitlements. Looking even further ahead, when the Commonwealth concludes water recovery programs and exits the market, all things being equal, we would expect to see some form of correction in entitlement values. But the quantum of this is very difficult to predict. Over the longer term, however, climate variability, land use change, and commodity prices are likely to remain the most significant drivers of entitlement values. Now, for everyone's favourite question, what does the crystal ball say about how climatic outcomes might play out in allocation markets this year? Well, in the seemingly unlikely event of continuing wet conditions, we would expect markets to trend downwards, with average annual prices around $150 to $200 in the Lower Murray. Under average conditions, prices are likely to remain relatively steady, with average annual prices between $300 and $400 in the Lower Murray. If the bond forecast is right and conditions through spring and summer remain dry, we could see average annual allocation prices approaching record highs. Perhaps the biggest takeaway from today's outlook is that uncertainty remains one of the most significant market drivers. What if the current outlook proves accurate? What if 2027 starts with a similar forecast? What if further water recovery is required, or if broader economic conditions continue to place pressure on asset values? None of these outcomes are certain, but all are plausible. The most successful market participants are rarely those who predict the future perfectly. They're the ones who understand their exposure to risk and position themselves early for a range of potential outcomes. For irrigators, that means water security. For investors, it means understanding portfolio resilience. And for all participants, it means thinking beyond the next allocation announcement and considering what the next few years could look like. Markets reward preparation, not prediction. And the challenge for market participants is to decide today what level of risk they're willing to carry if these scenarios begin to unfold. Now, before we move into our Q&A, I wanted to briefly highlight the breadth of WSP's water capabilities. Globally, we've got more than 4,500 water professionals delivering thousands of projects each year across 40 countries. Our services span the full water life cycle, from planning and advisory through to digital solutions, sustainability services, and future-ready strategies that help clients respond to climate, technology, and resource challenges. By combining deep technical expertise with global experience, we help governments, utilities, and industry deliver resilient and sustainable water outcomes. As always, if there's any economics, policy, or strategy problems that you need assistance with, please reach out to our team. Now, if you found value in our annual water markets report our monthly Water Markets Insights reports might also be of interest. Each month, our team distills the latest developments in climate conditions, water market activity, and key policy and management issues, all into a concise, insight-rich briefing designed to keep you ahead of market movements. And for those managing water portfolios, our Water Entitlement Index provides an independent benchmark with which to track market performance and support your investment decision making. Beyond market intelligence, we regularly assist clients with portfolio valuations, transaction support, and due diligence, helping them make informed decisions with confidence. And lastly, I just wanted to extend my thanks and the team's thanks to the brokers on the call who share their up-to-date market intelligence with us on a monthly basis, and who provide outstanding service to water market participants right across the basin. Okay, well, Steph, you've been monitoring the Q&A while I've been gabbing on here. So what have you got for us?
Yeah, there's a few questions we've got, Ben. We also had some pre-submitted ones, but the first one, I think it's more of an explainer question potentially, but do you have an estimate for the increase in the entitlement index being including the government buybacks?
Like a forecast? Is that what the question is? I'll take it as the question being a forecast. I think looking out to the year ahead, our expectation is that the Commonwealth is likely to remain an active participant for the 12 months ahead. So I think our expectation is that will keep a floor under entitlement prices, and therefore the index or entitlement value should remain steady, with perhaps some mild growth, probably focused on high security, high reliability entitlements. But also just wanted to highlight, in case that wasn't the question I was answering, the index does not, the values that back end into the index discount any known Commonwealth transactions.
Great. The next one would be, have entitlement values reached a ceiling? Low return on value, growth stalling, and a lack of capital to increase prices.
Well, I think they've certainly reached, well, they've reached the high back in 2023, and I think there has been quite a lot of pushback from a demand perspective over the last 3 or 4 years, where returns on those water investments have been relatively low by comparatively, as a result of high water availability. In terms of whether it is the ceiling into the future, that's difficult to know. I think that the investment thesis for water is still relatively solid, and the Commonwealth's purchasing activity is increasing the scarcity value of water entitlements, particularly in the Southern Basin. So over the longer term, the influences on entitlement values is likely, as I mentioned before, to remain commodity prices and broader economic influences, notwithstanding the potential for productivity increases via land use change or technological updates or improvements throughout irrigated agriculture.
Thanks, Ben. The next one is directed at me, but Ben, I'm not sure if you want me or you to answer it. It goes, thank you for the update. You mentioned SYDLAM shortfall of between 255 gigalitres a year to 355 gigalitres a year, with a likelihood of being at the higher end. What nominal volume do you estimate would be required to recover the 355 gigalitres a year?
That's a great question for you to answer, Steph.
Perfect. I guess the answer there is that I can't give you a definitive nominal volume answer, purely because when we're looking at nominal versus gigalitres per year, it is based on the LTDLE, the long-term diversion limit equivalent, which is different in every zone and entitlement category. And based on the fact that we haven't been told exactly which zones or entitlement classes or reliability is going to be recovered, there's no actual way to know the exact nominal number because it will vary from zone to zone. Some of them we're talking like 0.5, some of them are more close to 1, and that will just determine exactly what it is. So it's kind of a non-answer in that sense, but it will likely, the nominal volume will be a bit more than 355 gigalitres a year.
Yeah. I think if you look at the LTDLE factors and you take a midway point on what is the likely purchases, I think if, to answer the question, it's probably going to be a third higher than the LTDLE volume. So if it's 300, what did you say the high end was, Steph? 350?
355.
Yeah, so it'll be over 400 and approaching 500 gigalitres of nominal volume, depending on what entitlements are actually purchased.
Cool. Next up is, given the outlook for the Southern Murray-Darling Basin, are we expecting a reduction in the amount of annual summer cropping programs around the Murrumbidgee and New South Wales Murray basins?
This is a really interesting question. The truthful answer is I don't know. There's a couple of there's a couple of influences to this. So we have had good rainfall and soil profiles would be looking pretty good, and farmers like to farm. So it'll be a difficult decision not to farm given how healthy the profiles of soil are in terms of water there. There is water availability isn't terrible, and there is still a reasonable amount of water on accounts. That is leaning towards there could be a lot more than would otherwise be expected, given where allocation markets are at. That said, there's the other factor that's working against that is the issues around fuel supply and fertilizer supply, and the cost of that, which maybe they even out a little bit. I'm not 100% sure is the answer to that question.
Thanks. The next question is sort of along that same vein, I guess. But based on the maturity profile of current permanent plantings below the choke, how much additional demand do you see coming into the market into the coming years?
That's another good question, and one that we have answered through the work that we've done for the Victorian Government, DECA, on supply and demand. Rajiv, do you have those numbers handy in front of you? If so, you can answer the question.
Thanks, Ben. Yes, I do have it open in front of me, although I'm just trying to get the numbers. So just as a very rough approximation, so there is still some crop that remains to mature. So that could, just off the top of my head, it's about 20 to 40 extra gigalitres that could come from existing plantings as they continue to mature. And looking ahead in terms of new plantings, that could add potentially an additional 90 gigaliters of additional demand going to the future. So yeah, there's still some demand yet to come. And these numbers are for the connected Murray. So for the lower Murray, it's a little bit less than that.
Thanks, Rajiv. Any others there, Steph?
We've got a couple that have been submitted. We are seeing a downward trend in the reliability of forecasts. Even the past few months were meant to be almost certainly dry, and yet significant rainfall events occur. What is the likely impact of decreasing forecast reliability on allocation markets?
Increased volatility, I think, is the answer to that question, and certainly increased reactivity to rainfall, and I think where, for instance, at the moment, where people who are going to need water for the year are holding off purchasing because conditions are wet and the prices are viewed as too high. If the rainfall doesn't continue and it goes dry, then I think we'll see markets move quickly upwards as well. So that, I think, what we're likely to see is increased volatility.
The next question kind of can jump off the back of that. Are higher allocation prices still a short-term response to dry conditions, or are they now a longer-term feature of our drying climate?
There's a bit in that. I think they're definitely a short-term response, and we have certainly seen it over the last the last 3 or 4 years through the most recent La Nina, where prices at times were between $5 and $50 a megaliter at the height of water availability. So the bottom end of prices is capped. It can't go any lower than zero, whereas the high end is essentially unlimited. Of course, there's limitations in terms of what people can afford to pay. What we are likely to see is some impacts over the longer term at looking at averages, and the average price over the longer term is likely to increase with a lower volume within the consumptive pool. But at the same time, we're also looking at a more variable future climate, and so large swings in terms of water availability. It's difficult to predict and to know what the balance of those outcomes will be on averages specifically.
And apologies, Ben, I just need to issue a correction to my previous answer. So it was actually 67 gigaliters of demand from current plantings that's yet to come online. And yes, still 87 gigaliters from future plantings. And that's for the connected Murray.
Thanks, Rajiv. Okay, I think that's we're right on time now. So thank you everyone for your questions. Thanks for joining us today. Our report is available now on the website, so feel free to jump along and download that. We are recording today, and that will be available to everyone who's registered. Thanks again. Thanks to the team, Rajiv and Steph, Ellis and Duncan, and thanks to the tech team who are sitting behind making sure that our tech works today. Enjoy your day, take care, and see you next time.